You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and the author of the Options Playbook. Well, this week we still have some volatility. I was able to be with Mark Longo on the Volatility View last week, and volatility is staying steady. Right now we currently have the VIX index trading at 1825. And I should mention that we are taping Options Playbook Radio on a Wednesday, the 9th of October. The markets are open today, so we're doing this right around the noon hour. And the VIX index, even with the markets up about 1%, the S&P and the Dow at this point in time, we're seeing the VIX staying steady between the 18 and 20 range. And so just volatility overall is fairly high, and it's staying there. It's the drop-off between the expiration months is flat. There's really not a lot of volatility between the option contracts and the actual VIX future. So with that said, as an option trader, I would rather have some volatility with some predictability. Now, that's a little bit of an oxymoron, but I'm going to put it this way. If I'm going to be trading options in the S&P 500 index, which is a very popular index to trade options in, I would rather have a little more volatility than a little less volatility. It just makes your ability to do some option trades, it opens up the gamut of trades that are available because you have more premium in the option contracts because of the implied volatility. It's that simple. So in the SPX, kind of looking at doing a butterfly, and the SPX has so many different expirations, but butterflies become cheaper when implied volatility goes higher. And so today I actually looked at the VIX, and I looked at where the index is at, and currently I'm showing the S&P 500 index is up $23.65 on the day. It's trading at 2,916.71. And I'm getting a more recent quote on the VIX. The VIX right now is at 18.96, down $1.32. And I even went so far as to look at, well, we have an expiration today in the SPX option contracts. There is an October 9th expiration. And the reason why they have this Wednesday expiration is actually because of the VIX option contracts. The VIX option contracts expire on a Wednesday, so they actually have the S&P 500 index. They have an expiration also on a Wednesday, and that's because the VIX contracts actually are created because of the implied volatility in the S&P 500 option contracts. With all that being said, it just makes it interesting to have so many options in the S&P 500 index as far as expirations are concerned. So here's what we're going to do. I looked at the October 9th expiration, and I'm looking at the at-the-money call option right now, and I'm seeing that that is actually trading at a 20% implied volatility. It's actually a little bit higher than even what the 30-day VIX is at. So very short term, but we still got some volatility. So that means butterflies are going to be fairly cheap today in this expiration. And lo and behold, I went and looked at a butterfly and went 10 points wide with the SPX at 29.16, rounding off here. The most at-the-money butterfly that I could do in the calls is the 29.15 strike. That would be our middle strike in the butterfly. We're going to go 10 points wide. And if we look at buying the 29.05 call with the October 9th expiration, selling 2 of the 29.15 calls with the same expiration, and then buying our wing, buying the 29.25 call, that entire trade is done for $2.65. Now, with less than a day remaining on a 10-point wide butterfly, that's fairly inexpensive relative to if the VIX was trading at a 12% implied volatility or 11%. I wouldn't even consider a trade like this. And this is one of the things in the options playbook that we talk about, in that we're not looking at the options playbook and all the strategies and saying, oh, gee, I really like this underlying or that underlying. We're just looking at pricing in option contracts and using that to try to figure out, well, when might this trade work? And so a one-day butterfly it's not going to work in underlyings like Walmart that just doesn't have the volatility, or just blah stocks, meh stocks that just don't really do anything. You need a fairly expensive stock to get some premium in it, and the fact that volatilities are just staying steady, even in the very, very, very short term. We got a half a day for this butterfly to live. That's when it's an interesting time to do this. Normally, I would not want to do a half a day butterfly in the S&P 500 index. All right, so right now it's around noon. It's October 9th, and our paper trade for this week is going to be a 10-point wide butterfly in the S&P 500 index. We're doing it because the VIX is currently trading at around 19%, and the actual implied volatility on the at-the-money strike that we're going to be selling in the SPX is trading at 20.5% implied volatility. To recash what the trade is, we're looking at the October 9th expiration. We've got a half day until these options are dead. We're looking at buying the 29.05 calls, selling 2 of the 29.15 calls, buying 1 of the 29.25 calls. The midpoint right now is at $2.65. I would definitely want to work that trade. The SPX one-day option contracts usually have pretty decent volume in them and also halfway decent open interest. I would try to stay right within that level. But just to let you know, it is a fairly wide bid-ask spread in this butterfly, and that the bid right now is trading at $1.30 and the ask is trading at $4. I would never pay anywhere close to $4 for this trade. Looking at like $2.70, maybe giving up a nickel, and I would expect to get filled somewhere in that range, but it's never a guarantee. Now, if we do this trade, let's talk a little bit about the dynamics of it. The $2.65, if we were to fill at that price, would be the maximum risk. So for every 1x2x1 butterfly, we'd be paying $265 plus commissions. And commissions this week across all brokerage firms, including our own, have dropped precipitously. But with that being said, you still have to pay commissions, and you got to figure that in. So $265 plus commission is our maximum risk. Where does that risk come in? Well, we really want it to stay within our long strikes between the 205 and 225 range, but we got a half-day trade. So if we do the actual break evens, what we do is add the debit paid to the call on the low end and subtract the debit paid to the call on the high end to see the range, because it's very important, the range, especially on one-day option contracts. So the break even on the downside is $2,907.65, 2907.65, and on the upside would be $2,922.35, 2922.35. But more importantly, that gives us a range of $14.70. You got a half a day for this to trade. You got a $14.70 range that this could fall in, and we would basically make something on the trade if it stayed within that range. And if it just stays where it's at, the maximum upside that we can make on this trade would be the 10 points. Now, that's assuming it would go out right at 29.15, but it's the 10 points minus the debit paid, $2.65. The maximum this butterfly could trade for, or profitability, the max profitability would be $7.35 less commissions to put on the trade. So, interesting risk-reward going into a half-a-day trade. Volatility is just staying steady up above the 18% implied volatility range. We have a fairly decent up day that has kind of calmed down, so now all you're kind of hoping is that you just don't get any major news events to put on this trade. And we've got a $14 range that the stock can stay in. So our goal here is just to have basically boring trading for the rest of the day, let these option contracts expire, let time premium decay. And the biggest thing about time premium and implied volatility is that they can't beat expiration. When expiration comes, time premium has to go away, and also the implied volatility has to go away. So looking at the 29.15 call, which is $1.70 in the money, that call option that we're selling is trading for around $7 at the midpoint. So think about that. We have a half a day for that to trade. This basically has, I'm going to round off about, let me see where we're at, about $5 worth of time premium in it, and that time premium has to be gone by 4 o'clock Eastern time today. So that's why this trade is interesting. Overall, it's a great paper trade to watch. Now, if you're listening to Options Playbook Radio, you're probably listening after the trade has expired. It'd probably be fairly easy to see what has happened. In the SPX, all you got to do is look at what the closing price was. And another, I guess one last tidbit before I sign off here, is these are cash-settled options. So one of the great things about index options, is specifically the S&P 500 index, is that they are cash settled. You don't have to worry about exercise and assignment, because all that happens is cash gets transferred from the buyer of the option contract and the seller of the option contract based off of where the options are relative, the strike prices are relative to the actual index value. So it's a very straightforward process at the expiration of index options. That's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.